Hello, everyone, and welcome to today's webinar. We're so glad to have you here. This webinar is on strategies on how to improve your portfolio's cash flow, specifically for real estate investors. So if you are a real estate investor or looking to become one, you are in the right place. This entire session will be recorded and sent to you after the call. So if you miss anything, no worries, you'll get a recording of this. And we're always happy to talk to you one-on-one. We want this session to be a back and forth Q&A. So if you have specific questions about any properties you hold or about financing, we're absolutely here to answer those questions. And I am here today joined by our wonderful co-host, Matt. My name's Kayla Padel. I am our Senior Vice President of Marketing at Newfi Lending. And Matt, why don't you tell us a little bit about yourself?
Yeah, thanks, Kayla, and good afternoon, everybody. Thanks for joining. My name is Matt Brazil. I'm the head of our direct lending team here at Newfi, and I've been working in the mortgage industry for over 20 years. And I work with a team of loan officers here at Newfi that specialize in building relationships with property investors like yourselves. We assist them with growing their portfolios, optimizing equity, optimizing cash flow. So while Newfi does offer a full suite of lending solutions such as conventional, government, jumbo loans, what we really specialize in and where we're a leader in the marketplace is when it comes to alternative doc loans. So things like bank statements for business owners. And
Mhm.
really what we're here to talk about today, our DSCR lending program, which is geared towards property investors like yourself. So happy to get things kicked off here with Kayla. And with that, Kayla, we can get it going.
Perfect. And if you guys have any questions, there is a Q&A part of your webinar on your Zoom, and you can type your questions in the chat, and we're happy to answer those. So tell us a little bit, Matt, about Newfi and how we do specialize in those investors.
Yeah, absolutely. It's usually one of the first questions I get from a new investor is why Newfi? Or why should I consider doing business with you guys? And really, there's a number of things that allow us to stand out in the marketplace, some of which are on the slide here. But let me just start by saying we're not a hard money lender. Rather, we're a national lender offering some of the most competitive pricing in the marketplace. We offer common sense, exception based underwriting with daily calls with our head of underwriting, where we discuss unique situations and one offs, things as an investor you deal with every day in your lives. We're here to look for ways to meet those needs. And really, over and above that, we're backed by our primary investor, Apollo Global Management, which is one of the largest asset managers in the world, providing Newfi the strength and the stability to weather all markets so that we're here for you when you need a partner. So when you look at the slide here in front of you, over and above that, as I mentioned, our competitive pricing is every day we're reviewing where we're at within the marketplace and making sure we're near or at the top of that rate stack. We specialize in working with investors like yourselves. We're here to provide solutions for purchases as well as refinancing out of higher interest rate debt, as well as getting cash out of those properties and unlocking that for additional opportunities. Whether that be helping investors get out of blanket mortgages, hard money loans, one of our specialties. And again, the greatest part of all with DSCR financing is it's simple. It's simple compared to a full doc loan. Not nearly the amount of documentation is required, which means faster turn times. And again, that's one of the first questions we often get. How quickly can you close? Well, we can close about as quickly as you can get us documentation, generally within 2 to 3 weeks when you factor in appraisal turn time. So very fast in terms of getting these loans from start to finish.
Amazing. And we have over 2,000 five-star reviews on Google and experience.com. So we love working with investors, and I love that they love working with us. Now, you touched on our DSCR loan product. For people who are not as familiar, can you tell us a little bit about DSCR?
Yeah, so if you haven't had a DSCR loan in the past or haven't heard of it, DSCR stands for debt service coverage ratio, and it's just a way of saying, does the property's rents, do they cover the monthly payment? So we're looking at the total gross monthly rent relative to the payment, principal and or interest typically, We'll talk about interest-only options here in a little bit, plus taxes, plus insurance, plus homeowners association, if there is one, or if it's a condominium complex. So we're looking at, does it debt service coverage cover? The loan itself is geared towards for investment properties. So it's not for a second home. It's not for a primary residence. It's for a home that is rented out. And the beauty, again, of this program is it's based on cash flow. It's not based on your income. It's not based on any debts that you may carry on your credit report. So we're not asking for tax returns. We're not asking for profit and losses. We're not asking for schedule of real estate owned. We're simply looking at, does the subject property cash flow? And if it does, that's primarily what we're basing the loan decision on. So it's very streamlined and very simple from a documentation standpoint.
Yeah, and let's take a look at how those calculations pan out.
Right. So another way to look at DSCR is, does the subject cash flow right? So are we getting the cash flow we need to be able to qualify the loan? So at Newfi, we can go down as low as 0.8, or basically saying, another way of saying, the rents cover at least 80% of the monthly payment. Now, ideally, we're 1-to-1 or better. And as an investor, I'm sure that's ideal for you too, because not very often are we looking at holding a property that's going to be losing money on a month-to-month basis. So that being said, we have ways to make those projects work that may be a little bit under the 1.0 threshold. But in general, we're looking for at least 1-to-1 or better. At 1.25, we're going to have some pricing advantages. So what you see on the screen here are just some simple examples of math showing if I had a $2,500 a month lease and my payment comprised of principal, interest, taxes, and insurance are at least $2,000 or at $2,000, then that would be a 1.25 debt service coverage ratio. And then likewise down below, $1,600 monthly rent, $2,000 full all-in payment would put us at 0.8. So again, also ability to make those work.
And we have a great question here.
Yeah.
How do you determine what the rent is if I haven't got the property yet? Which I think
Yeah.
leads to what we're about to talk about next.
I mean, talk about segues, right? That's you couldn't have written that one up any better. So thanks for that question. So yeah, the next slide touches on exactly that. So how do we determine rents? And there's a few primary ways in which we do that. So generally speaking, on a purchase transaction, it's going to be based on the appraiser's estimate of rents, which is called a 1007 report. It comes with the appraisal. So they're going to not only tell us what the home's estimated value is, they're going to tell us how much it could likely rent for, or what other similar homes in the marketplace are renting for. Now, that being said, there are times when a home is being purchased as an investment property where maybe there is a track record of it being rented in the past, or maybe there's renters in the property currently. In those cases, we will look at the current rents the property is bringing in, or we can look at the rents the property is currently bringing in as an alternative, or in collaboration with that appraiser's estimation of rents. But generally, 95% of the time, we're looking at that appraisal. For refinances, it can be a few different things. If it's a property that's been owned and actively leased, generally speaking, we're going to look at the current lease that's in place for a long-term lease. However, if it's a recently acquired property, or if it's in between tenants, or if the property's been under renovation, let's say, in those cases, we have the ability to use a 1007, the appraiser's estimate of rents, in lieu of having an actual lease in place. And then for short-term rentals, which we also offer financing on, then we're either using a look back on the actual STR reports, whether that be through Airbnb or VRBO or another third party, or alternately, we can also use another tool, which is called an AirDNA report. AirDNA is a third-party website that offers projections on what a property could short-term rent for. So we've got some ability to use those projections in our analysis as well, if we don't have, let's say, a full 12-month look back on actual rents. So a number of ways in which we can establish those rents over and above just having a lease.
Perfect. Question answered. Now, can you tell me a little bit about some of the strategies you see the investors you talk to every single day using when they use a DSCR loan?
Yeah, absolutely. Here we've got just some common examples of ways in which we're helping people every single day. So if you look at what are those most common examples, essentially we're helping folks in increase their holdings, increase their portfolio through the purchase and acquisition of new investment properties. So for us, that means a 1 to 4 unit property. It's going to be a stick-built dwelling, so we don't do manufactured housing. It can be a condominium, or it could be a townhome, for example. We're doing that through competitive pricing and really just simple, easy process there. With respect to refinancing, we're doing two things. Obviously, one of them is just getting clients out of hard money. We're getting them lower interest rates. A lot of times it's a balloon payment may be pending, or it's trying to get out of a blanket loan. There's all kinds of different scenarios we may look at for the rate term refinance need. Could be buying out a co-owner or another investor that might be involved in the property, or it could just be simply improving the monthly cash flow as well, trying to bring that payment down. And then the other way of refinancing to your advantage is using that to take cash out. So we've got equity locked up in properties often that could be used to either renovate properties, maybe the subject, or maybe other holdings an investor may have, or taking cash out for the purpose of acquiring additional projects. But again, we've got the ability to help in multiple ways. Those are just some of the scenarios that we see most commonly.
And I'd love for you to talk about, a recent deal. We were talking about this offline that you had that just, major benefits to the end borrower.
This is a loan that we just recently closed. It was an individual, just like the scenario I was sharing, was in hard money, sitting at 10.95%, had a $230,000 balance on an interest-only loan. So their payment every month, not even including, of course, any principal, any taxes, any insurance, was just $2,098 on its own. We were able to come in, we did a cash out refinance. So essentially we got the borrower loan up to $297,000 on a 30-year fixed at 6.875. So dropping their rate over 4 points. Their principal and interest payment came down to under what they were paying for interest before on a lower loan amount, down to $1,951. And they pocketed $57,000 or roughly that after closing costs in cash. So ultimately, not only did they benefit from the cash out, but they are saving almost $10,000 a year in interest just in the first year. So again, a pretty incredible, incredible turnaround story in terms of just that one property, how we were able to help.
And if somebody wanted to find our pricing, who do they connect with?
Yeah, the best way to get current pricing, because there's so many different options when it comes to pricing a DSCR loan and so many different factors that go into that, the best way to do that is to reach out to me and one of the loan officers on my team. At the end of this, we're going to get you all the contact information for myself and my team so you guys can reach out as needed. But we're going to introduce here towards the end as well, more of a self-service website that we've got available where you can go in and you can run scenarios and do some pricing. But again, to get a real custom price, the best way to do that is to talk to one of our LOs.
Perfect. That's such a helpful group. So talk to us about what types of properties you can do a DSCR loan on at Newfi.
Yeah, so this is important. So what we focus on are 1 to 4 unit investment properties. So we're not doing multi-unit beyond 4 at this time. So again, those would be site-built condos or townhomes. We do offer financing on both long-term and short-term rentals, as well as mid-term rentals. Depending on the marketplace you're in, that might be something that is in need as well. We also can offer some options around co-living scenarios. So again, that's an up-and-coming area that a lot of investors are taking a hard look at, is how do I maximize my rent? How do I maximize my cash flow by, instead of renting to just one family, how do I rent each room individually? That's the co-living model. Pad Split, one of the major companies out there, third parties working with investors on this. That is something that we can do on with some limitation in terms of the collateral. And if there's been any major modifications done to the home, we'd want to look at that. But again, we can offer options there typically. And then again, another area that a lot of lenders won't look at are rural properties. So with some limitations, we're able to offer financing for rural properties up to 5 acres. And then another competitive advantage for us too are the up and coming ADUs in a lot of markets. So ADUs, accessory dwelling units, very common in so many markets these days. Again, a tool to maximize rents. And the problem with ADUs oftentimes is they may have been built some point in the past by a previous owner, and they may not have been fully permitted. So we do have some abilities to navigate around those challenges that other lenders may not be able to. You've got an ADU and it wasn't fully permitted. Let us take a look at it. We may be able to help.
Awesome. Okay, we've got a question, a scenario, and I don't know if we can answer on the call, but you might be able to, Matt. I have a property with a loan balance of 425,000 at 5.25% along with a co-owner. However, I want to see if we can do a DSCR on my name and remove him from the loan altogether. But can we do the same around that rate, 5.25? I have a 790 credit, renting room by room, bringing in 3,000 a month.
Yeah, I mean, great question. So let me just kind of address the major crux of the question. Obviously, is in getting buying out the other investor that's involved in the project. So absolutely, we do that all the time. So it sounds like the property is likely cash flowing. It's a rent by room scenario. So again, that is something that we can absolutely take a look at and likely assist with. The interest rate, on the other hand, you got a great rate. Let's face it, mid fives. Those rates currently don't really exist in the marketplace for DSCR loans or for really any property, to be honest, right now. Even if someone's buying a primary residence, it's tough to get something in the fives unless you're going with a VA loan, or perhaps, an FHA might get you close. But we can certainly get close. So while we might not be in the mid fives, we're certainly in that 6% range. So when you look at the need here, being able to get the property out of an individual's name into your name, and what that might look like from a pricing standpoint. Again, with great credit, depending on what that loan to value comes back with, we can certainly land in the 6% range, and I think make a strong case for it being advantageous.
Amazing.
But for customized, for something that a little more customized, we can definitely talk offline. I'd be happy to run some numbers on that one.
Perfect. Thank you so much for the question. And let's talk a little bit about those credit guidelines. Where do people need to look at for DSCR loans when they come to Newfi? How much do they need to have down? Tell us a little bit about the loans that we do here.
Yeah, the third line there, 640 minimum FICO. So one of the advantages we have is we can go down to the 640 range. So again, a lot of what we can do will hinge on where that credit score does land. So when we've got some of the lower credit scores, that may limit certain things like loan to values, but ultimately we can go up to 80% LTV or loan to value, meaning 20% down or 20% equity when it comes to either a purchase or a rate term refinance, meaning we're not taking cash out. So with cash out, it's a little bit more limited. We can go to 75% on the cash out basis. So those are the two numbers to really make note of, 80 and 75%. Loan amounts, we can go up to $3 million. So in some of the larger markets around the country, we can certainly accommodate some of those larger homes and larger loan sizes. And then in terms of options, most of what we do these days are fixed rates. There are some ARMs out there. We're not really doing a lot of ARM options at the moment, simply because the way the market is positioned, ARMs aren't really that advantageous, so fixed rates really are currently in vogue. However, interest only is a major option out there for a lot of investors. We offer an interest only option on pretty much all of our term loans, and it's one great way to keep that monthly payment in check. So if you've got a property that struggles to cash flow, running it on an interest only oftentimes can get us there. Prepayment penalties, we haven't talked about that yet, but that's another big option that we offer in most states around the country. There are some states that limit prepays or don't allow prepays outright, but a prepay is a great option for a property that you plan on keeping long term, mainly because you can offset some of the interest rate by taking a prepay. So for example, we offer prepay options stemming from 1 year all the way out to 5 years. And within that scope, we've got a number of different types of prepay options, from a straight flat prepay of say 5% penalty to the step down method of a 5, 4, 3, 2, 1. So we've got different options built into it. But ultimately, no matter what you choose, if you take, for example, a 3-year prepayment penalty option, it's going to reduce your rate significantly compared to taking no prepay at all. Essentially, it's giving the investor that confidence that that loan is going to be around for a period of time. They're giving that rate benefit back in return. The last 2 bullet points are important too, because again, these are 2 things that Newfi does that a lot of other lenders don't. But first and foremost, we don't require sourcing on large deposits. So let me give you a quick example of why that would be a benefit. So a lot of investors, when it comes to purchasing a new property, may need to move money around and are moving money in and out of accounts, which if we have to source where a deposit came from because a large deposit shows up on your bank statement, that means we have to, or a lender has to, go back and ask for additional documentation. Okay, I see you have a $50,000 deposit. Great. Where did that come from? Oh, it came from your brokerage account. Now we have to get brokerage statements and so on and so forth. At Newfi, we don't require sourcing of large deposits. We take the 2 months of bank statements that you provide, and we go off of the balance typically that's going to be on there. We're not going to ask for further evidence or further clarification of the source of those deposits. So that's a big win because it just means a simpler loan process. The last bullet point, unlimited number of properties. Again, as you may or may not know, for example, if you go with a full doc loan through Fannie Mae, you can only have, if it's an investment property, a maximum of 10 financed properties. Outside of that, Fannie Mae won't offer financing. So oftentimes the number of properties owned causes investors to run into problems with future financing. So at Newfi, with our DSCR loan program, we don't cap the number of properties that you own. In fact, we don't even ask you about the number of properties you own, because the only 2 properties we care about are the one we're financing and your primary residence. So we're going to ask, where you live, obviously, but those are the only 2. You could have 2 other properties. You could have 200 other properties. We're going to focus on just the subject property and the property that you reside. So again, it's a win, and it's a way to reduce documentation.
And can people be a first-time investor when they're using a DSCR loan?
They can, yeah. We offer financing in very similar fashion to an experienced investor for first-time investors. So the only qualification is that you can't be a first-time home buyer, meaning you have to have owned a property at least in the past 3 years, whether it be a primary residence or another investment property. But as long as you're not a first-time home buyer, the DSCR program can work for you.
Wonderful. And what about vesting in an LLC? I know a lot of investors run these through LLCs in their businesses.
Yeah, it works both ways. So you're not required to invest or to vest the property in an LLC, but you can vest the property in an LLC. And I shouldn't just limit it to LLCs. You can vest it in an LLC or a corporation or a trust. We have all kinds of different vesting options, but it's optional, not required. So we leave it up to the investor to determine how they'd like to vest their property.
Amazing. I love how flexible we are with our investors and the ways that you can structure deals to fit each individual's needs. And we have this, I know you talked about it a little bit earlier, but this amazing tool, you want to tell us about it, the DSCR calculator?
Yeah, so this is the calculator I was referring to. So it's the self-serve tool that we offer for investors to be able to go in and you can create scenarios for either properties that you may already own and you want to run scenarios for a refinance, for cash out, or you might want to create a scenario for a new purchase. you can use the DSCR calculator for all of those reasons. It allows you to not only create the scenario, but save the scenarios. So essentially, when you come back after having spent time on this, all the scenarios that you created are still there waiting for you. You're also able to pull real-time rates when you're running your scenarios too. It also helps with structuring because the tool is going to let you know what those maximum loan to values are, based on the credit score that you input. So it's going to do a lot of the work for you in determining what's allowed via our policies and what may not be allowed. And like I mentioned, it's also going to give you pricing for the day. So each morning we update the tool with our current day's price. So that way you're working with real numbers. You're not working with, what you think might be the actual numbers. Come to find out, maybe it's not. We're giving you real world tools to be able to self-serve and crunch some numbers. And then when it comes time to fine tuning, the tool also gives you easy access to one of our LOs to be able to reach out to and customize those quotes and the scenarios for yourself. So at the end of our presentation here, we're going to make sure that everybody gets a link to the tool. You can go in and check it out. And as you have questions, please feel free to reach out to us.
Yes, when we send out this recording, we will send out that link to the calculator, which we're super excited about. We have another question. What percent of down payment is required for a DSCR loan for an experienced investor?
Yeah, no problem. 20% down is the minimum down that we're looking for. The criteria there, for the most part, generally we're looking for a credit score right around 700. Below 700, there could be some additional down payment required. But at 700 or better, then usually the minimum is going to be 20%.
And the second part of their question is
The
also,
only, again,
oh yeah,
the only caveat to that would be, yeah, there are some scenarios where if it's a short-term rental, we might need 25% down. So without getting into the weeds too much, again, in the vast majority of scenarios, it's 20% down.
perfect. And they also had, do you have any liquid funds requirements for a DSCR loan?
The only, outside of if there's a down payment or funds to close requirement, we do on a purchase and on rate term refinances, we do look for reserves. So again, depending on the loan size, the reserve amount could differ, but generally speaking, the liquidity requirement is 3 months of reserves outside of any funds to close.
Yep. Perfect. Well, with that, if you guys have any more questions, if you want to talk through specific scenarios, we want to talk to you. We want to help. So please reach out to Matt through this email, or connect with us through our phone number on our website. We are always here to assist you. And I really appreciate you, Matt, for jumping on and sharing your expertise with us today.
No, it's my pleasure. Kayla, thanks for hosting. Thanks everybody for joining. It's been a pleasure and look forward to hopefully talking to you here in the future.
Love it. Have a great day.
Okay. Thanks.